For more than a year now, the world's financial markets have been in fine shape. There was a small dip between October and November 2020, but nothing serious. Still, the aftermath of the crisis of anti-COVID measures is on everyone's mind. Despite what the economy has suffered, can stocks rise to the sky? The nature of any bubble of overconfidence in the markets will end very badly. However, when you are not in the bull markets, you miss a performance of the moment. So today, should you be investing in stocks? Come on, let's go. One of the keys to understanding the phenomena of inflections on the market is a notion of marginal performance. For example, did you know that the price of a listed company is equal to the price of the last transaction multiplied by the number of shares? It is not the average price of the day, but the last transaction. No matter what happened during the day, if the ExxonMobil company is worth $263 billion as I write this video, it is because the last share sold was bought at $62, and there are 4,230,336 shares. Whatever happened before doesn't matter. A marginal price is a price set at the value of the last trade. More trivially, if you get run over by a train, it is only the first wheel that hurts, no matter how many cars follow behind. So when you say that the markets can't go higher because they're already high, that's a nonsensical argument. The problem is not whether they are high or not, but whether a trigger will reverse the trend. That's why, in the example of Shiller's price-earning ratio, which consists of looking at the price of a stock in relation to its equivalent in years of earnings, we know that the markets are expensive, but that doesn't tell us at all whether they will turn around. I know they're expensive because historically, in a disinflationary environment, you buy a stock at between 10 and 20 times its earnings. So at 37, I'm very expensive. However, during the internet bubble, we went up to 45. I repeat, the levels do not allow us to know when the markets will turn around. All they allow us to say is that selling the markets is expensive, and buying when they are not, with PE below 10 for example, ensures that you don't make mistakes. On the other hand, this does not allow you to know when to sell because if you had sold when the Shiller PE went above 20, you would have sold in 1998. You would have bought back only in 2009 to sell everything in 2010. In short, you would have made money between 1998 and 2009, and apart from that, nothing. Yet stocks have been rising extraordinarily since 2010. What is the problem? Financial markets do not work with averages, but with thresholds and marginal phenomena. But then, what makes a financial world go round today? That's where economic modeling comes in. At Cal Intelligence Software, a consulting firm to the world's largest institutions, they have created a model that brings together 7 major macroeconomic factors. It appears that today, 2 major indicators are at work in driving the markets higher: the strength of world trade and liquidity. For liquidity, the explanation is simple. The American and European central banks are pouring tons of money into the markets, to the point that all prices are rising. Even basketball trading cards are going up in price, as are the balance sheets of the FED and the ECB. The floodgates are open, but that's not all. The crisis of the anti-COVID measures has brought world trade to a halt and is the second major factor that has plagued the markets. Factories have shut down, and inventories have collapsed even faster than sales. Today, we are seeing a resurgence in global trade as the world anticipates the end of the COVID epidemic. In the USA, Europe, and in rich countries that have launched an intensive vaccination campaign, the epidemic is regressing. Overall, even on a global scale, the number of COVID deaths appear to be on a downward trend. However, all is not so simple with this epidemic because humanity is bringing a very specific and not very diversified solution thanks to the almost unique strategy of vaccination. If it is a solution that works, then we may defeat the epidemic. But if new variants appear, then they will happily pass through the defenses of most of the world's countries. Put another way, in the face of a global pandemic, if we had adopted different strategies country by country, then risk of a variant bypassing all these strategies at the same time would have been much lower. This is the whole problem of homogeneity, which is very effective, versus diversity, which is less effective but more resilient. In short, today the markets are seeing that the world trade is going well and that liquidity is present in abundance. As a medium-term outlook is good as long as the epidemic remains on the ropes, they have no reason to turn around. That's why I'm keeping my stock portfolio and not selling. The future is full of challenges, but at this point it's going up. Obviously, there are market stressors to watch. As far as the recovery in global trade, inflation is on everyone's lips. And it's not a false sentiment because that's it. More than half the countries in the world have switched from a disinflationary to an inflationary regime. What does this mean? We know that disinflation is favorable to the rise of the price-earnings ratio because disinflation allows us to project ourselves more serenely into the future. On the other hand, inflationary periods have two characteristics. Firstly, they are medium-term force against the trend in price-earning ratios. It is mainly because of inflationism that the prices of the SP 500, but also the major European stock exchanges have made some gains between the 1960s and the 1980s. It is not for lack of economic growth at that time, but against the grain, inflationism was devouring the future. Secondly, if growth is not fundamentally strong, inflationism works against central banks. If our inflation comes from commodities, no central bank can print oil. All this helps to explain why crashes in inflationary periods can be much more powerful than crashes in disinflationary periods. Apart from the case in 1929 where we experienced a major deflationary recession, the other major crashes that we call Ursus Magnus in GaveCal research occurred during inflationary periods. So when we go into an inflationary period in the context that we are in today, it means that the intensity of risk increases. If the markets crash, they have a good chance of crashing harder. But then, how do we know? That's all the work we do with Naster, our online platform for free management assistance. With the economy quadrants, we measure the intensity of the risk. With the financial quadrants, we measure the probability according to our risk occurrence model. Ideally, the percentage displayed is the equity exposure you should have. This allows you to time your equity exposure based on the macro weather for the month ahead. Finally, with the Mason's Behavioral Index, our model tells you when to get out and when to get back in based on the market sentiment. Basically, when the financial quadrants are in the orange and the economic quadrants are inflationary, you pay much more attention to the Mason's Index because you know you're on the edge, according to our model. Finally, to know when to buy stocks, we like to reason on the basis of the standard deviations from the long-term trend. Put another way, a company with strong fundamentals has a long-term trend around which its stock price oscillates. As I said at the beginning of the video, the further you move away from the long-term trend, the greater the probability of returning to it, either up or down. For example, a company like McDonald's that has strong fundamentals has stock price that is in line with its long-term trend right now. However, there are times when the share breaks out of its pattern for one reason or another due to the market fluctuations or black swans as in 2008. At that point, if I make sure the fundamentals of the company are good, I know I can take advantage of a good entry point. So for now, I remain bullish overall on the equity markets until our model turns around. I know that the situation will be hard to live with in the years to come, but you have to know how to manage your savings according to the current situation and not as you anticipate it. On that note, see you soon for new videos. Ciao!
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.